Like most businesses, online businesses need capital to grow. And when you think about financing your online business, you likely think of banks first. But while bank loans may work for most businesses, when it comes to e-commerce, banks just don't understand online sellers. There are many reasons why e-commerce companies struggle to get loans from banks. Firstly, e-commerce is a relatively new industry for banks. They're apprehensive about entering a new space where their procedures are untested. Banks generally choose lower risk, more traditional avenues to lend. Banks see e-commerce as risky. E-commerce businesses do have higher fraud rates and more space for security breaches compared to conventional businesses. Banks account for these increased risk factors and prefer to work with industries with less exposure to risk, because banks at their heart are risk averse. Typically, banks are most knowledgeable about markets closest to them. When a business opening in the same town applies for a loan, they can evaluate if that business will resonate with the town's residents, who are also its customers. At least that's the way it used to work. With national banks stretching across the United States, banks no longer have that local insight. That's why they're more interested in focusing on putting their money in areas where there is less risk and where they see it as a sure bet. E-commerce companies are the opposite. Banks aren't really familiar with global trends. When they feel they can't accurately assess where customers for the business will come from, and they feel that they can't predict an outcome, their result is to say this is too risky. And this leads to many e-commerce companies' loans being rejected or being approved for smaller amounts with higher interest rates. In the event that an e-commerce business fails, banks don't believe that there are assets that they will be able to recover from the loss. The way that banks work, if you think about a mortgage, is a bank takes the house if someone stops making payments. Business loans work much the same way, and they're built on a conventional understanding of how businesses work. If a business fails, the banks take their premises, they take the computers, they take all of the things of value. The problem is that in banks' view, e-commerce companies don't have things of value that can be easily taken. Banks are not comfortable with the lack of assets that e-commerce companies have, even if those e-commerce companies have fast-growing, healthy businesses. Finally, while conventional businesses have a plethora of assets that could be seized in the event of non-payment, the only assets that e-commerce companies have are generally inventory. But that inventory is tied up in a complex supply chain, often being held in a warehouse, like an Amazon warehouse, that doesn't belong to the e-commerce seller, or being shipped across the sea from China, all of which raises red flags for banks and makes them think that it is a risky investment. At the end of the day, banks just simply don't get the e-commerce space. They don't understand the metrics, they don't understand the business process, they don't understand why e-commerce companies tie up so much of their capital in inventory that takes weeks to arrive, and why e-commerce companies don't get paid from the big marketplaces for weeks on end. Banks don't get that e-commerce companies need funding now to be able to grow their business tomorrow. But luckily, banks are not the only game in town. There are other ways for e-commerce companies to get access to funding. Today we're going to look at two such ways, one called factoring and another called capital advances. Factoring is when a company purchases unpaid invoices and takes over collections. For example, a factoring company might pay you in advance the money that Amazon will pay you in a month. It sounds like a good deal, but those factoring companies take a substantial percentage of that sales revenue. They also generally lock you in for a period of time that could reach up to 24 months, where they're taking that substantial percentage from your sales for that entire time. On the other hand, a capital advance is essentially an advance based upon future sales revenue, meaning it allows you to grow faster without the drawbacks of bank loans, whereas factoring is designed to harmonize your cash flow so you don't go in the red in a given month. Capital advances are designed to do more. Yes, you can harmonize your cash flow, but you can invest in a new product line, you can invest in marketing, you can invest in growing your business. Ultimately, capital advances allow you to grow faster without the drawbacks of a bank loan or factoring. That's why they're a great solution for e-commerce companies. Getting a funding solution from a capital advance provider is fast and easy. With Yardline, the application process lasts about 3 minutes, and you get an approval within 24 hours. You can receive up to $1 million in funding. Yardline was built by online sellers for online sellers. We know the e-commerce space in and out. We have a team of experts as well as a series of tools that we make available to our customers to help them not only get the funding that they need, but to optimize their businesses and to think strategically how to grow them. Contact us today or apply for a capital advance on our website.